Good afternoon and welcome to today's Filbrandt & Company Financial Update webinar. Today we will discuss the so-called Brexit vote, that is the British vote to leave the European Union, and its impact on financial markets. We'll also discuss the U.S. economy and all investment alternatives here at home. And finally, we'll talk about how university professionals can try to protect their retirement savings in a world where there is significant economic uncertainty and social unrest. Good afternoon. My name is Jim Twesme. I'm a financial advisor at Filbrandt and a member of our firm's investment committee. With me today is Robert Parham. He is our chief investment strategist. He's a chartered financial analyst and has more than 30 years of experience in the investment industry. Good afternoon, Robert.
Hi, Jim. How are you?
Very good. So, Bob, in the market update we did in April, there were three investment themes that you discussed, and I'll just list them briefly. First, you were positive on the prospects for the U.S. economy and that you felt that so-called value stocks were a better buy than growth stocks, and I'll ask you to define those two terms later in the presentation. Second, you believe that stocks outside the U.S. Were attractive, and investing in foreign stocks provides beneficial diversification. And then finally, you talked about the significant risk of investing in bonds, especially Treasury bonds, and that TIAA Traditional, an alternative available to university professionals, was an excellent alternative. So does that sum more or less?
Absolutely. First of all, we were very positive on the outlook for profits. Profits had been hurt dramatically in 2015 and early 2016 because of energy prices and the strong dollar. We saw that instead of being a headwind, we saw that becoming a tailwind late this year, which would help profits. Our positive attitude on, and we thought that was going to drive the market up. Our positive attitude on international stocks came from the fact that Great Britain had started to recover from their economic sluggishness, as did Europe. And Europe in particular had been very, very sluggish for a number of years, off and on, with the exception of Germany. And it looked like that was altogether turning around and that Europe was going to pick up. We wanted to own foreign stocks primarily for their diversification value and for the pickup in growth that it looked like was going to happen. Finally, we pointed out that we thought there was significant risk potentially in the U.S. bond market, particularly as it pertains to long-term Treasury bonds. Interest rates at the time were very low, the lowest they'd ever been, and that just posed a risk in our mind. Rates are even lower today, though. We've been wrong on rates for a long time, and so is everybody else, but they keep going lower. At any rate, we continue to believe there is significant risk in the bond market.
All right. Well, let's get an update on your thoughts given the events of the last 3 months. First, let's talk about investing in foreign stocks, especially given all the press about the Brexit vote. How are you feeling today about investing outside the U.S. and what do you think are the impacts of the Brexit vote?
Well, I think Brexit was a negative. It was a political vote, not an economic vote. I think the separation of Great Britain from the European Union is not a good thing. I think the trade advantage that the European Union had will diminish with the absence of Britain, and I think Britain's trade advantages will diminish as well. So I think Brexit was bad news in a lot of ways for Europe and Great Britain. Investing outside of the United States has lost some value. There's still the diversification that you attain by investing outside of the U.S., but the fact is that growth is going to slow in the European Union and Great Britain over the next few years. Businessmen are confused about the final outcome of Brexit. Hence, they're unlikely to make major investments over that period of time, so many capital programs are going to be curtailed until there's more certainty on the outcome of Brexit. So we frankly think that the positive attitude we had on foreign investing has been greatly diminished.
All right, so did you adjust client portfolios as a result of Brexit?
Yeah, we did. We sold a fund that was not hedged to currency. We were concerned that the fund was an international fund and was investing heavily, primarily in Europe and Great Britain, and we felt that that was just going to be a weak sister for a long while because of currency issues as well as the slowing economy in those countries. So we sold that off, Jim, and the cash that we accumulated from that sale is now held in cash. Our cash positions at Filbrandt have been managed at about 2 to 3% for a number of years. They've been very low because there's no payout on cash. We've doubled the level of our cash position right now. We will reinvest those proceeds when it's opportunistic, but right now I don't see any opportunities.
All right. You used the term when referring to the fund that we sold down, the fund did not hedge the currencies. Can you explain what that means?
Yeah, not every fund hedges currencies. In fact, most of them don't. But what that means effectively is this. When you have volatile currencies, you hedge those currencies against the amount of a position that you may have in those foreign stocks and bonds. And this essentially isolates your return to the return from the stocks going up or going down. Now, there's some cost to that, but it's gotten less and less and less over the years. And today, it seems to me more important for mutual funds to hedge their currencies that they're investing in.
Okay. Well, what about investing in other parts of the world, say Asia, for example? What are you thinking about that?
Well, surprisingly, Asia had been problematic for a number of years, mainly because China has been slowing from over 10% growth 4 or 5 years ago to about 6.5% GDP growth today. So the reason for that has been they are basically trying to transition their economy to a consumer economy and away from an investment economy. And that's requiring them to slow the economy down to allow for that transition. As a consequence, we've minimized our Asia investments up until now because of that slowing in the Asian economies. I think that may be changing, and we got some good news out of China last week. That is to say, their GDP was flat to up a little bit from the previous quarter. You can't always trust what comes out of China in the way of information, but I was a little surprised that there was an uptick in the GDP number. That means to me that the government is telling you things are doing well. Let me just say one more thing. And we haven't made any decisions on whether to put some money in, more money in Asia as of this point, but it's looking better. So we haven't pulled the trigger, but it is looking better.
All right. When the results of the Brexit vote were announced, I think it's fair to say it was a surprise. Is that not?
Absolutely, yeah.
And the reaction around the world, including the U.S., was stock markets sold off. They went down substantially for a couple of days. We now find ourselves in a place where most of the markets have recovered, and in fact, in the U.S. market, we're trading at all-time highs. So what do you make of this?
Well, people were really surprised. I don't know any professional in the business that wasn't surprised, and that was the reason for the sell-off, because ultimately Brexit, I think, will be a negative for the European economies, and the feeling, I guess, in all the confusion was that ultimately this feeds into the U.S. But as people thought about it, the reality is that it will have very little impact on the U.S. economy. That's point one. Point two, the reason stocks are doing as well as they are right now is that the profit outlook that we talked about earlier in the conference hasn't changed. We're likely to see a positive turnaround in earnings, corporate earnings, probably in the third and fourth quarter of this year and carrying through to 2017. That's good news. And then finally, foreign investment in the U.S. has really ramped up. And I think that those dollars are chasing quality, which is the U.S. markets right now. Hence, the U.S. stock market is hitting new highs.
Okay, so since we're talking about the U.S. stock market, let's go back to the discussion of value stocks versus growth stocks. As we mentioned before, we made a decision earlier in the year to migrate away from growth stocks towards value stocks. So first of all, can you explain the difference between those two concepts, growth and value?
Yeah. We adopted a growth posture in our portfolio in 2008. I started with Filbrandt in late 2007, and by 2008, we'd assessed the outlook for the market as being a recovery, but a slow one. We had been in a financial recession. That is the primary reason that recovery is slow. When you have a financial recession, it takes a long time to rebuild back from all those leveraged situations that you're trying to recover from. As a consequence, we felt the economy would recover, but would recover very slowly. And so I went to Mike and I said, Mike Filbrandt, and I said, Mike, look, what we've got to do is we've got to invest in companies that can create their own growth, that aren't tied directly to the U.S. GDP. Hence, let's swing our portfolios in the direction of growth mutual funds. And that made a lot of sense back in 2008, and it has worked. You can see in the graphics up here, the blue line are growth stocks, and you can see they have outperformed the value stocks in the red line there fairly dramatically. It's almost been 2 to 1. As a consequence, value companies, which are more or less old-line blue-chip companies, industrials, manufacturers, transportation companies, most of these names you would know. They're slower growing companies, but the attraction is that they have fat dividends usually relative to growth stocks, and they're cheap, 10, 11, 12 times earnings instead of 14 to 20 times earnings. So they're much cheaper, and the dividend payout is much more robust. Now, growth company gives you a healthy return from the growth that it engenders itself. A company like Amazon, for instance, is a classic example. Netflix. These companies grow 20 to 30% a year, and they don't pay dividends out because they have to finance internally that growth rate. As a consequence, you're not getting dividends. What hopefully you will get in a good growth company is appreciation in capital gains.
All right, so how have growth companies versus value companies done so far this year? Well, we have a chart here that shows actually year-to-date, value companies were up over 6% and growth only a little over 1%. So at least thus far, this strategy seems to be working. But what do you think about prospects for value stocks going forward?
I think it's a long-term thing, Jim. A lot of the turn, when it occurred, was driven by a firming of prices in mostly commodities, agricultural commodities, industrial commodities, and especially oil and gas. I remember natural gas was down less than $2 an MCF. I think it was approaching $1.60. It's about $2.80 today. It's gone up even more than oil. Oil, on the other hand, has recovered from $25, $26 a barrel to $45 a barrel. And valuation on the securities was so low, I think we've got years to build back valuation. The graphic that we've got on the screen right now goes back to 1952. It's the price to book ratio of oil and gas companies in this index. And what you can see there is we're still very close to the lows, historic lows over the last 60 years. That provides incredible long-term appreciation potential if oil can hold on to its price, and we think it can.
All right, so growth stocks over several years led the market. Looks like there may be a transition now to value stocks leading the market, but the market is at all-time highs. We've got a chart here that shows where we've come since. This is a long period of time, but still we're at all-time highs. Some might call it frothy levels. What do you think about the prospects for continued growth in the stock market?
Well, I think that this ought to be presented on an exponential curve, not because that does look pretty scary. But I think that I don't think that this is a frothy market at all. We're still talking about reasonable multiples in the stock market. We're at 17 times earnings right now. If you use forward earnings, that's a reasonable multiple. Historical averages would put it at about 16. But it doesn't get, the stock market doesn't get pricey until it's over 20 times earnings, and we're nowhere near that. Earnings are turning around, by the way, so that's going to bring the multiple on earnings down as the earnings do make progress. So I'm not worried about the stock market in the near term. I think it's reasonable value. Now, another thing I want to point out here, and this is perhaps an important reason for that spike in the stock market and the fact that we've gone to new highs almost daily for the last 2 or 3 weeks, and that's that we've got a lot of foreign investors in the U.S. market, both stock and bond market. These are new investors to our markets, but the reason they're coming here is because ours is the most predictable, solid, high quality, both currency as well as market. And as a consequence, if you're in Europe and you've got a currency you're nervous about, the potential breakup of the European Union, and you're worried about the EU, you're going to want to put your money in a safe place. That means the U.S. stock market. So we've got more customers for our investments.
All right, the stock market is trading at all-time highs. Let's look at the bond market. After the Brexit vote, the yield on the 10-year Treasury went down to what, like 1.3, the lowest?
Yeah,
on record.
1.38 or 3.6. It was somewhere in the 1.3s.
Lower even than it had been during the Depression of the 30s.
Oh yeah. We've been lower than Depression levels for a number of months. Boy, we've taken that out for a long time ago.
So, do you see any ongoing impact from the Brexit vote on interest rates in the U.S.?
Well, yeah. I mean, you have to recognize the fact that the Federal Reserve has had their hands tied. They wanted to raise interest rates. They've been telling us that since last December when they raised rates a quarter of a point. But the Brexit vote and the repercussions that will probably play out in Europe because of the uncertainties have got the Federal Reserve on hold. So they're not going to raise rates this next meeting. They've said they'd like to raise them before year end, but I don't know that they'll be able to do that, because what's happened is definitely going to slow the European economies and the British economy. It won't have much effect here, but the Federal Reserve has to recognize what's going on in Europe and has to be careful in terms of raising rates. So the outlook for rates is probably going down, is probably stronger today than it was before Brexit.
All right. Well, you were a little nervous about longer-dated U.S. Treasury bonds in our last webinar, interest rates have come down even further, which when that happens, the value of the existing bonds goes up. Can you sort of explain that phenomenon?
Well, sure. Let's say you go out and buy a bond today. You pay $100 for the bond. It's a 5% bond, so you get $5 a year in terms of interest. But then all of a sudden, to your surprise, interest rates go up. And now, you know, the new bonds are yielding 10%. So instead of getting $5 on a $100 bond, you're going to get $10 on a $100 bond. So if you're sitting there with this 5% bond and you want to sell it and go and invest in that 10% bond, you're going to have to mark it down in price to make it competitive with that 10% bond. Hence, you effectively drop the price by 50% in order to sell it in that market that it's competing in. So that's what happens. When interest rates go up, bond prices fall. And when interest rates fall, bond prices go up. What concerns me about the interest rate market today, even though it's probably a coin toss as to whether interest rates are going to go up or go down in the near term, the impact, the negative impact of rates going up is many times greater than the economic impact of rates falling would be positive. As a consequence, you know, even though it's a coin toss which way rates go, it's very concerning to me that the risk, if interest rates do go back up again, are enormous for our clients. And our clients are very conservative, mostly retired or approaching retirement people.
Mm-hmm. Well, I tend to agree with you. I think there is some significant risk in the bond market today. What alternatives do we have on the fixed income side?
Well, we do have one good alternative, and if we didn't have this, that's TIAA Traditional, I really don't know what we'd be doing. But TIAA Traditional is a terrific alternative. It's available in almost all university retirement systems. It's a stable value annuity. It's producing between 3 and 4% on historic investments. It guarantees principal, so that if rates do start to rise, your principal is not at risk, like that example that I gave you with the 5% and 10% bonds. Your principal is never at risk with this. Meanwhile, the 3% rate of return that they're guaranteeing you is substantially higher than current Treasury bonds. The 10-year Treasury today yields 1.5 or 1.5. So it's twice that level. And I just think that makes it a very, very attractive product in the world that we live in today. The rate of return is competitive. The principal guarantee is wonderful. You got to remember that TIAA is a AAA rated insurance company, so you've got a very solid backer of this product.
Well, let's talk about inflation for a minute. Inflation is and has been very low in the U.S. and most of the rest of the world, but there are signs, are there not, that there is some upward pressure on inflation? That's the first part of the question. The second part is if inflation does increase significantly, are there investments that may not necessarily benefit from it, but be a good hedge in an inflationary environment?
Yes, I think so. Let's talk about inflation first. Anecdotal evidence is telling me that wage rates are going up right now. J.P. Morgan announced an increase for most of their employees. That's very unusual for a bank to be doing that. Most banks today are laying off people. Starbucks just last week announced an increase for their employees. We remember some time back when McDonald's did it. It's happening pretty much around the country. We're at 4.9% unemployment. That's a very, very low level. So we're really pressing into service the last available employees, and we're having to pay premium prices for those people. Wages are the key to inflation. Product or commodity prices can go up and go down, and they will affect inflation, but they can fall fairly quickly and fairly dramatically. Wage inflation is the key to overall CPI inflation, and we're seeing that right now. Now, you ask about investments in an inflationary environment. Generally speaking, hard assets are the best investment in an inflationary environment. So let's say we're going to a 2 to 3% inflation world in the next 12 to 18 months. If that were to occur, I think hard assets would be much better investments. It's one of the reasons that value stocks, I think, have picked up. Now, what do I mean by hard assets? I mean commodities, agricultural, industrial. Gold is a good hedge. But for us, the most attractive investment for an inflationary world is real estate. The TIAA Real Estate Fund is the fund we're using as an alternative investment that I think will really prosper if we get back into an inflationary environment. The most negative effect of higher inflation will be on growth stocks. So once again, here's some support, more support for our value versus growth emphasis.
Right. And the TIAA Real Estate Fund has been in existence, I believe, for over 20 years. The last several years it's been producing rates of return in the high single digits or low double digits. So, you know, it has been a very good performer.
Actually, I think it's been publicly traded since 1995, but it has been managed by a real estate fund has been managed by TIAA going all the way back to the 1940s. They are a very experienced manager of real estate. Insurance companies do two good things. They manage real estate well, and they manage bonds well, because that's what drives their business. So we rely pretty heavily on this real estate fund and think it's a great product, and will protect us a little bit in the inflation world that we see.
All right. Well, that's very helpful insight. You know, we've talked about several different investment alternatives, from foreign stocks, domestic stocks, bonds, real estate, and you've discussed it primarily within the context of economic fundamentals. But there are all of these events going on, these disruptive events going on in the world, such as the terrorist attacks, the most recent one in Nice, the attempted coup in Turkey. We've got targeting now of U.S. police officers, and here comes the presidential election. So how does this, if at all these events factor into your management of client portfolios?
Well, I think you have to pay attention to them, and I think you have to draw negative inferences from these events. But the fact is, if you go back to the 60s and early 70s, which is when I started in the business, things were much worse then than they are today. The stock market survived and went up, so I think that will happen again. But it is very troubling, no doubt, particularly overseas. So the way we're dealing with it is we are diversifying our portfolios. We're maintaining that diversification. That's why I talked about international. Even though we've de-emphasized it recently, we still want to maintain a position there and want to go back as soon as we see some clearing in the woods. So I think that's what you have to do. You just have to be cognizant of the problems out there, and that they are mostly overseas. They're not here. We've been through these kinds of disruptions before, and we'll survive this one. But make sure you've got substantial diversification in your portfolio, so if one sector of the portfolio doesn't perform, you can pick it up somewhere else.
And just to follow on to that thought, you talked about the migration to value stocks from growth stocks. But we haven't abandoned growth stocks in our portfolios. We've just put more emphasis on the
Yeah, I think you phrased it correctly. What term did you use when we talked about it last?
We migrated or put more emphasis on value stocks.
Right. No, we haven't abandoned growth, and I don't want to abandon growth. It wouldn't make sense, but if we do get into a more inflationary environment, we just won't add it.
All right, very good, Bob. Thank you for your thoughts. Let me just summarize what we talked about. First of all, the Brexit vote certainly creates the uncertainty, and therefore, Bob, you're more cautious about the financial markets in the UK and Europe. On the other hand, you're cautiously constructive on the U.S. market, due in part to the flow of funds coming from investors overseas. Third, interest rates are very low, which has increased the value of existing bonds, but at the same time, there is significant risk that investors could lose money if interest rates start to go up. TIAA Traditional is an alternative to think about. With regard to inflation, if it does increase, you want to have some exposure to hard assets such as real estate, and TIAA Real Estate is a good alternative and available to university professionals. And then finally, in this uncertain world of ours, it's important to diversify across all of your fixed income, your equities, and alternative investments. So does that sum it up?
Sounds like a good summary.
All right, Bob. Well, thank you again for your thoughts. Now I'll turn to our participants. We will be responding to your questions in just a few minutes, so please continue to type them into the chat window. If you stayed with us this long, we do have a special offer for you. It's our market update, and it covers the topics that Bob covered today. It's available to you at no charge. Just type the word report into the chat window, followed by your name, and we'll get the report out to you shortly. Or you could also call the number on the screen, 800-431-9740, and say you'd like to receive a free copy of the report. And finally, you could also access the report yourself directly on our website, and we'll be posting in just a second here the URL in the chat window, which you can click on, and will take you directly to our report. Our financial advisors, the financial advisors here at Filbrandt and Company, will be, we specialize in working with university professionals, and we will be visiting the universities on the screen here in the near future. If you would like to meet one of our advisors in person, just call us again at the number 800-431-9740. You can also, as an alternative, type the word meeting into the chat box, followed by your name. You could do that right now. Today is the latest stop on what we call our 2016 Financial Freedom Tour. It consists of webinars, seminars, and in-person meetings. Our objective is to share our wisdom on matters affecting the finances of university professionals like you. You can learn much more about the Financial Freedom Tour and what we call the Filbrandt Advantage at our website, which is at www.filbrandtco.com. And if you'd like to respond to any of our offers, including this one, you may at any time call us, again, at the number 800-431-9740, or you can email us at webmeeting@filbrandtco.com. And now we will address your questions. We likely won't get to all of them. If your question is not answered during this presentation, then we'll follow up with you with a phone call or via email. There's the URL for the market update, so you can copy that right now. All right, Robert, we do have a few questions. One has to do with the presidential election, which we made brief reference to. The question is, Hillary Clinton and Donald Trump appear to be very close in the polls. Which candidate would be better for investors?
I don't think there's a clear answer to that. I've said in the past that Donald Trump is such an unpredictable character that the market will treat his candidacy, if it survives, as an uncertain one, and for that reason, I think it will perform more poorly than if Hillary is perceived as the favorite. Hillary's a better known commodity. I mean, she's been in position of power for a number of years, and I think most people know and understand where Hillary's coming from. So because of that more certain world, I think the market probably would do better with Hillary early on. But looking down the road, I think it's a different ballgame. I think that Donald Trump will practice processes, procedures, and programs that will be more beneficial to the U.S. economy.
All right. The next question is, when do you think we will have a better sense of the impact of the Brexit vote?
Well, it's a good question. I'm not sure anybody knows the answer. Article 50, which has to be exercised, this is, by the way, the divorce agreement, the divorce negotiation, but it has to be exercised by the British Prime Minister, which hasn't been, we know who it's going to be, but it hasn't been done yet. And Article 50 could be exercised sometime in the next 2 or 3 months, but then they have 2 years, once that's done, to negotiate with the European Union on what the terms would be. So at a minimum, you're probably looking at a couple of years down the road. Unless something surprising happens, and it could happen, good news could come out of this. European Union could agree wholeheartedly to whatever recommendations Britain makes. So there can be some good news. It's just going to take a long time, I think. I think a minimum of 2 years before we know for sure.
There's also some speculation that, in fact, Britain will not exit the European Union. It was just an advisory vote, and some people have stated that when Britain learns the cost of exiting the European Union, they may decide to back away from that.
Yeah, you're right about that, but the fact is, the new Prime Minister has said Brexit is Brexit, okay? So I got a feeling that she's going to follow through on this thing, even though there is an economic impact that's not going to be positive for Great Britain. Now, I could be wrong on that. Nobody really knows for sure, but that's why it's so up in the air. I mean, that's why there's this incredible uncertainty.
All right, the next question, we did make some, or you did make some references to the possibility of inflation. Do you have an inflation forecast?
Well, yeah, I guess. I mean, you have to think about inflation if you're an investor, and although we haven't had any inflation in this, meaningful inflation in this country in this century, I started in the business, and the last time we did have meaningful inflation, and that was in the 1970s. If you remember that graphic with the 10-year Treasury bond showing you the peak in interest rates, Treasury bonds got to 15% at their peak, and they've been coming down ever since then. So it's been essentially a 35-year bull market in bonds as interest rates have come down, and particularly because inflation has come down. That seems to be turning around now, and I don't know that I have a lot of confidence in any forecast of inflation, but the trend seems to favor higher inflation numbers as long as we have an ongoing economy that's growing. it seems to favor more inflation down the road, and that would seem to favor value stocks and hard assets.
All right, here's I think we have time for one more question. This ties into what you were just talking about, because you had discussed real estate as a potential inflation hedge, and you did mention gold. The question is, what about gold? And would it, if you were going to invest in gold, would it be better to buy the metal itself or buy the stock, the equity in a gold mining company?
I think I'd buy the ETF, GLD, as opposed to taking on the risk and the hassles of the hard assets, actually putting gold in a safe at home. I wouldn't do that. I mean, who knows who's going to figure out what you got there and then try and rob you. So I don't think I would do that. But gold has been historically a good hedge when inflation was rampant, and that occurred in the 1970s. Gold went from $32 an ounce to $400 an ounce between 1970 and 1980. But understand this, gold prices were fixed until 1973 or 72. Fixed, okay? So maybe the real price of gold was much higher than 32. I think it was. So that appreciation, 12, 15-fold appreciation over that decade was not just inflation. It was a reaction to the realities of things. Maybe gold doubled in that period. So it was a good inflation hedge. Would it do the same thing today? I can't tell you whether it would or not. Gold has not been a good hedge against currencies. We always thought gold would be a hedge against currencies, but it has not, for U.S. citizens in particular. As a consequence, I wouldn't buy it as a hedge against currencies, because the dollar is the strongest currency in the world. So you don't need to hedge the dollar. What I would suggest, if someone is interested in owning gold, is to buy a small position and as a calamity hedge, so to speak. And I would do that by picking up the GLD. I wouldn't put a whole lot more than 5 or 6% in gold, but that's kind of the way I come down on it. I've got a very small piece in my portfolio. Not going to make me rich, but if we have a revolution in this country and Western Europe goes to hell in a handbasket, that gold may go up quite a bit.
Is that what you're predicting? Okay. Thank you very much, Robert. To our participants, we want to thank you for your time and attention. And again, if you would like any more information on these topics or Filbrandt & Company services, please call us at 800-431-9740, and please have a great evening.